And we should be recording now. All right, so amazing day, and we're going to get started. All right, so like I said to you, what we're going to be looking at today is how to increase your win ratio, not necessarily your risk to reward. You're going to more than likely reduce your risk to reward, but increase your win ratio. How we're going to do that is by zooming out and looking at larger time frames. Okay, now as we just happen to be on gold, we'll look at gold. Okay, normally I'll come in and I'll mark up all of these charts but in my outside candle watch list. All right, and you can see gold here. I'm going to mark it as a green for a previous bullish outside candle. Okay, but let's actually look at what's going on. Let's zoom all the way out. Now we understand market structure and price action. Yeah, we understand that the first thing we need to do is we need to look at the larger time frames to see what the markets have been doing. Okay, it doesn't matter what we believe that the markets are going to go and do without understanding what they've done. Okay, we can't just say, well, you know, I had a dream yesterday that gold was going to tank, or I've been on Twitter and everyone's been saying that gold's going to go to hell, so you know, I'm looking to sell. Well, that's not how we trade. We want to understand what the market has been doing. Those two lines in there that I've just put in there from 2003 are not my opinions. They're not about my dreams. They're not about my aim. These are facts that since 2000, around this time here, 2002, the market has been making higher highs, higher lows, and higher highs. If we understand that the top of any range is a premium and the bottom of any range is a discount, we can see this huge 20+ year range. We are in a premium. Okay, this market is in a premium. Gold is very expensive now compared to what it has ever been, well, since, you know, within this range, what to be honest, when it's ever been. Okay, so we understand that much. We can put in some more lines. Those lines, once again, are not because when the market hits the blue lines we're going to hit sell, we're going to hit buy, but it focuses our eye to be able to see what's going on and when and how. Okay, so have a look here. I've just seen JJ. We didn't connect yesterday. Please, we'll do it today, please. So only because it passed my mind and I completely forgot. All right, but let's just connect to today if you can. All right. So you can see here, within this range, the market has been making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. This is not my opinion. This is a fact. Okay, this is a fact. We drop down to our daily time frame, and we can see the markets come up into that premium. I'm going to make the premium line a little bit of a thicker line so we can always understand where we are. So I'm tagging these two lines here. 1, 2. I'm changing the pointage to there you go. All right. So we're up in the premium, and we can see since we got into that premium, the market's actually, from a daily perspective, been consolidating, been trading within 2 points. It came up to this point over here. Okay. And then it came down over here, and the market has been trading within this range. Okay. Once again, that is not my opinion. That is a fact. Okay, that is a fact that the market's come up to this point here. It's made a higher high here, then it's broke structure here, made a lower low, breaking structure, but then it's come back up, made a high, and then made, you know, a higher low, and then made an equal high, and then made a lower low, and then made an equal high. Well, I think it's fair to say that we're in this range. We're not decided right yet what we're going to do. Okay, we're in this range when it comes to the daily time frame. However, there's still lots of trades to be taken because we are day traders, and this is the daily time frame, meaning that every single candle is 24 hours in time. 24 hours is a long time for us to make some profits. We're going to drop down to our 4-hour, and once again, if we want to understand what's been going on, we can draw some lines in here. I'm going to draw some lines in here. I'm going to make them a different color, all right, so that we can identify them. I'll make them green in this instance, like so, and like so. We can see that the market has been bullish, making higher highs and higher lows and higher highs and higher lows and higher highs up to the top of this consolidation range. Now, maybe the market wants to push down from this consolidation range, but we do understand that when we see equal highs, all right, relative equal highs, we understand that above those relative equal highs lies something that we call liquidity, okay? Liquidity is a pool of money that sits above and below major swing highs and swing lows. And the understanding and the maths behind that is that that's where people think are very strong levels of structure that the markets may not break, and that's where they place their stop losses, okay? So therefore, that becomes very attractive to the market of coming and taking that pool of liquidity, okay? Now, we can also understand where we are in regards to session liquidity, all right? So if I put on an indicator here, which is just purely showing me the sessions, okay, here, we can see how within that this market has where we are in regards to session liquidity. So we can see over here, we can see a New York session high that was taken by this wick. And we can see all the way over here, there's an Asian session high that wasn't quite taken by that push up, which is there, which I'm going to mark as liquidity. But if we zoom into what's going on right now, we'll be able to see what's happening right now today. Okay, right now today, we can see that there was some Asian session lows over here that were taken by by the price, all right, taken by the market, liquidity taken. And we can see the next bit of session liquidity sitting over here, okay. Now, we understand liquidity is one draw on price, but also we understand there are other things that are a draw on price, including imbalances, all right, or inefficiencies, all right. People call them fair value gaps. So we saw one that was in here, but the market's actually pushed into there this morning. As we can see here, London started, it's pushed into there, taken liquidity from below Asian session lows and pushed into this imbalance that you can see here that I'm going to label imbalance. This is me reading these candles, okay? And today what we're going to do is we're going to try and work out a way that we can increase our win ratio. And it ends up, ultimately, more than likely, we will drop our risk to reward, but we will increase our win ratio. Okay, now how we're going to do that is by staying away from the very small time frames and making sure that any stop loss we place above swing highs, and we allow our trades to play out, okay, meaning win or lose. Okay, so right now we can see how these markets came up here and over the last few sessions made lower lows, lower highs, lower lows, and lower highs. Now we've just taken some liquidity from below here, below this Asian session low, but we understand that overall, we're in a premium. Overall, we've come up here into this level, and we've actually just started to break some of this 15-minute structure here. Look, there's some structure here. If I put a line in here, okay, and then, oops, let me put a smaller line in there. Okay, and the market has broken that structure, made a lower high, and it looks like it's trying to break and close below here, making a lower low, okay, which ultimately could be an indication, correction, and continuation on a bigger picture, lower, placing our stop above this high, on a bigger picture, targeting liquidity, opposing liquidity, potentially. This is us looking at a 15-minute time frame. Okay, now we do understand that there is liquidity up here, but the market took this liquidity and then didn't go for this liquidity straight away. So maybe it doesn't care about these highs, but I am concerned about these equal highs. All right, these equal highs I'm talking about, these relative, this level in here. Obviously we did got a nice grab of liquidity above these highs. I'm still concerned about this liquidity here. However, I have to trade what I see. Okay, so right about now we can see liquidity has been taken from this level here. We might get a reaction up into this level, but ultimately maybe the market decides to close below here. Okay, making an indication, a correction, and a continuation in line with coming from a premium, potentially targeting previous liquidity, as in opposing liquidity down here, okay? But we have to watch it. Right now, the market is sitting in a previous battlefield, which is this imbalance, but this level in here that previously the market couldn't break, this high, and then broke it with strength and speed, okay? We understand that the market, this is also another milestone here, could possibly be trying to get down into these levels. And what we're going to be doing here is, like I said to you, we're going to be working on taking trades where we can increase our win ratio. I don't want to hear people taking 80 trades and winning, 20 of them, 15 of them. Yeah, I want it to be the case that you're winning, at least 50% of your trades. And what that's going to mean is that you're going to give your trades a lot more space to breathe, yeah, which is going to reduce your risk to reward. So you're not going to be taking 100, 1 to 10s. You're going to be looking to take 1 to 2s and 1 to 3 trades. Yeah, if you get 1 to 5, then you pick 5, then you pick Kaye. Yeah, but we're trying to increase your win ratio and your confidence in your abilities to trade. All right. So we're going to be going no lower than 5-minute time frame. Okay, we are going to be going absolutely no lower than the 5-minute time frame. Okay, and even then, we are going to be targeting. We are going to be making sure that our stop losses are above swing highs. Yeah, that our stop losses are above swing highs. Okay, let's have a look at this chart based upon our time frame and let's see if we can understand anything. All right. So on the hour time frame, we can see that the market made here's a low, here's a higher high, here's a higher low, here's a higher high, here's a higher low, here's a higher high. We can see how the market's wicked below that structure, low, lower high, potential lower low here. Maybe the market's going to make some sort of lower high into here first before continuing to come down into these levels. Hence the reasons why right now, if we drop down to a 5-minute time frame, liquidity's been taken from here. And look, if we look at it on a smaller time frame, okay, which we're not going to be for this session, we may see in here an entry for us to be able to get into this trade on a smaller time frame and be able to get some sort of push up. We're not doing that. We're going to be looking for the sell. Okay, we're going to be looking for a sell, and that sell may come as this market comes and pushes back into a point of interest. We can see a lovely manipulation M, and we can see some imbalances in and around this area. Okay, we can see imbalances in and around this area. Okay, so maybe this market comes up in here. Maybe this has to push on further. Doesn't matter to me, because regardless of whatever happens, I am waiting for my confirmations. Another thing that we can do is, as we spoke about, is we can look at some additional confluence in the form of our divergence and our correlating pairs. So this XAU, which is gold, and a correlating pair with our gold is silver. Okay, so if we go like this, and at the moment, for example, we start to see any divergence, we start to see the markets doing different things in regards to, different areas where the market's pushing down or pushing up. We start to see different things happening. But that can give us some sort of inkling that maybe something else is going to happen. And maybe there's going to be a reversal in the market. All right. Say, for example, here, look at this example, and it's only part of, what, a bit of a confluence. So there is some small structure in here. We can see lower lows, lower highs, lower lows, equal highs, lower lows, higher high, boom, 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 like this. But look at that little example from here to here. Like this is a small, it's not a great example, but from here to here, I'm going to make it a color. I'm going to make it a color, so we can see it in a solid line, and make it pink, thicken it up. The market's moving in that direction. And then from in our correlated pair, we can see the market here moving from here to here. All right. And therefore we can see there, based upon this little push up, after that little push up, we may get a decision for the market to sell off, which the market has done. All right. Now that's not the be all and end all. Okay, that is just an additional bit of confluence that we can look at. Now, the reality is when we should be looking for those confluences after we're seeing liquidity being taken. So look, liquidity's been taken from down here. All right, liquidity's been taken from down below this Asian session low. Let's have a look also over here. See if I've got my indicator here. All right, now we can see, let's say for example, there was New York session low over here. Some session low stuff happened here. We can see some liquidity over here. All right, so when this liquidity has been taken over here, I'm gonna drop my time frame down to a 1 minute time frame. I know I said that we're not looking in there, but I'm just giving you guys to see, show you liquidity, show you divergence. Look, for example, here, we can see this market here, making a low, making a little high, making a little low. We can see this energy happening in here of the market coming from here to, even if you want to say to here, okay? And vice versa over here, we can see this market coming from here to here with these data points. Yeah, we're getting some divergences in the market, making this market move in different ways, and may indicate a potential reversal of this energy of it coming down here, seeing the markets pushing up into this level. Now, this isn't a be all and end all. It's just an added confluence. Now, I personally think that what's going to happen is this market's going to push up bullishly as we see it doing now. We're not getting in the trade. All right, we're going to watch it. They push up, have some sort of bullish push into this area, maybe here. You know, I'm looking at it on this silver. I'm not that fond of silver because of the spread and whatever it may be, but we're using it as a correlated pair. And we're wondering whether or not this market's going to, whether we're going to tap in here and then continue becoming bearish. But what we're going to do is whatever trade we take, we're going to put in our stop above the swing high and allowing our trade to play out. Because what we want to do is we want to practice how we can take trades and increase our win ratio. Now, our win ratio and increasing our win ratio doesn't necessarily mean that we're making more money. Yeah, risk to reward is what's about your money, but win ratio is about your wins and your confidence in being able to take trades. So say, for example, if we target, let's imagine that we took a trade now for the sell after we saw this market pushing down here and closing below here. Let's imagine we took an entry here, for example, and placed our stop above here. Our target may only be here as our first milestone, taking this liquidity for a 1-to-1, and then potentially taking the liquidity below this London session low, maybe if we're getting carried away over here for a 1-to-2. And you're going to close your trade at that point in time, and you're going to be happy because you increased your win ratio, and then ultimately you are reducing your risk to reward. But I want you to get into the vibe and the feeling of being able to win more trades than you lose. Okay, I think there's far too many people that have gotten a little bit trigger happy, telling me that in one day they've taken 30 trades and blah blah blah, and not winning enough. So the reality is, I'm going to let you know about my gold concerns. My gold concerns is there is some liquidity above, is that we are trading within a bigger consolidation range, which is that gray block. All right, that's my concerns. However, I'm going to trade what I see. Therefore, in a smaller time frame, I see market structure breaking, and potentially there's a potential for this market from up here to get down to the bottom of this middle gray box at least. Potentially. Okay, there's also potential for this market to decide to go up to the top of this gray box here, and therefore we will be stopped out. Okay, if it decides to go up here, decides to make a higher high, and whatever it may be, and that's the risk that we run. Yeah, but that's not more than likely going to happen today, because that's the weekly range. This is the daily range of this daily consolidation that we're in here, and we're actually looking at an even smaller time frame to see if there's an opportunity. All right, so I'm not trying to get in here for no buy just because a little bit of liquidity is taken from here. This market, yeah, might decide it wants to go all the way up in here and take some liquidity. Yeah, it may do. Yeah, it may decide to go all the way up in here again, take liquidity, and then start pushing down. It may do. If that is the case, I will watch it doing what it needs to do. Okay, and then I will hopefully this market will turn around before it breaks this swing high, yeah, and then give me an entry either up here, yeah, but whatever I do, my stops for today are going to be placed above swing highs, okay, which is going to, in many instances, it may reduce my risk to reward, but it may increase my win ratio, okay. Now, there's a lot of traders out there that take trades with one-to-ones. But let me tell you something. If your win ratio is you win 8 out of 10 trades, but they're only one-to-ones, you can be a very, very profitable trader. Yeah, it means that most trades that you take is going to hit profits. Yeah, though it's not going to be, you're doubling up. You're going to be doubling up. Some guys out here say, no, I'm going to risk 500 and I'm going to take a one-to-one and I'm going to make 500. Or maybe you take a 1-to-2 and you're going to make $1,000. If you can do that more times out of 10, 6, 7, 8 times out of 10, but your win ratio is quite small, you can still have a very profitable strategy. And at least you've got the confidence that every time you open your charts to trade, you can actually make profits. Forget about 1-to-10s, 1-to-20s. I took a 1-to-1,000 trade, 1-to-Kabili. Forget about it. I want today for us to focus on understanding how we increase our win ratio. Yeah, and increasing our win ratio will mean that we will reduce our, well, let me say it 2 ways. It may mean that we reduce our win ratio, okay? However, we could still keep a very good risk to reward. However, we are going to be in a trade for a lot longer time. Okay, so instead of us being in a trade for an hour or two, we may be in a trade for the whole 5, 6, 7 hours, the whole day. Yeah, as this market, for example, taps in and starts to move down in here, wriggling down, impulsing, retracing, impulse, retracing, impulse, retracing, impulse, retracing. Who knows? Let's see, in one day, let me go to a daily time frame. In one day, this market is able to move. I'm just going to do a quick measure. For about 340s. So let me just go here, see where we are right now. Like, it's not impossible for this market to get all the way down here today. Not impossible. Did it yesterday. It moved that distance yesterday. Okay. And I'm saying to you, if that was the case, then our little trade that we're saying has got placing our stop above, the swing high like this. If we measure that out here, it's coming all the way down here. Could be a nice 1-to-4 trade. 1-to-4 trade, 1-to-4, 1-to-5 trade. All right. And that's me placing a stop above a swing high. And let me tell you something as well. This is going out to somebody on the call. They know who they are. Even if what you're going to do is you're going to practice being able to just take this trade and letting it play out. What does that mean? That means if it comes over here, stops you out, I want you to let it stop you out. Yeah, I don't want you to move your stop loss. I want you to win or lose. Okay, there's not enough in it for you to be worried about, I'm going to move my stop loss over here and blah, blah, blah. For now, I want you to win or lose from the trade. Get into the habit of being able to place your trade and then leave the rest on God. Yeah, that means even if this market comes and starts wriggling backwards, yeah, it may start doing this. This may come all the way to tap in here. It's just taking liquidity and wants to come all the way back up in here and take the liquidity back from the Asian session. It's going to stop you out. You're just about to get stopped out. And then it starts to do this. And you finish your day and you say, Jay, see that trade, yeah? Bruv, I was holding my breath and it pushed all the way up there. But by the time New York session started, boom, we was off to see the wizard. All right. I want to get into the habit of being able to let your trades play out, not fiddling with them. I think we've got a lot of fiddlers. Want to fiddle with the trade, want to move stops. As soon as they start seeing blue and start seeing some money, because maybe that they're down in their trade or maybe that they're not confident in their abilities, the first thing they want to do is close themselves out of trades early. And then they look at the trade at the later on in the day. When I say later on in the day, I'm not saying looking at 8 or 9 o'clock at night. I'm saying it's morning time now. It's 10 o'clock, 8, 9, 10 o'clock. You got into a trade, and then you look at your trade again at 1:30. Maybe even later than that. Maybe the markets have opened. It's 2:30, 3 o'clock. And you look at it then, that's not a long time. That's just you getting on with your day, and then you're looking back at your markets, and all of a sudden, that trade that you took that was up here, it's down here. And you're like, rah! Yeah? And that's, at least then you're going to get confidence that you can understand market structure, you can understand price action, and though you may not have mastered entries on a very small time frame, you can get in and out of trades and you can make money. That means if somebody spoke to you and your life depended on it, they'd say, listen, you can look at them in the eyes and say, bro, I can double your money for you. I'm quite confident I could double you your money. Give me £100. I'm quite confident I can make you £100 and give you back your £100. Knowing that you make 1 to 2s. So you can actually take £100 off the top. You can give a man back his £100, have £100 on top, 100% return, and take £100 off the top. Now that alone makes you quite powerful. That alone puts you in a position of confidence. Are you out here caning the market for a 1 to 25? No, you're not. You're not taking £1 and turning it into a Lamborghini. You're not. It'll be nice, but you're not. All right? I want today and next week, I want it to start next week, but I'm prepping you for next week. I'm prepping you for next week. I want you guys to have a week of being able to take a trade, and your trade you're interested in is, what you're interested in for that week is your win ratio. Therefore, if you take this trade and you're in this trade, I want you taking no more than 1 trade at a time. Ooh, that's what I want you doing. Yeah? No more than 1 trade at a time. If you take this trade, don't tell me right now you've got 4 or 5 trades open at the same time, all in different markets, one in gold, one here, one. Just don't tell me that. I don't want to hear that nonsense, Fraff. I want you taking 1 trade. I'm applying some strict rules. So for next week, these are the rules, and you're going to journal it. A lot of people are scared of journaling. You know why? Because they take too many rush trades. You take so many trades, journaling with them trades would be a full-time job. You're like, I took 47 trades today, I've got to journal them. Yeah? That's the problem. So we're going to fix that problem. We're going to fix that problem by making you take a lot less trades and making sure you place your stop above the swing high, which is going to reduce your risk to reward. It's going to mean your lot size is going to be a lot smaller, and it's going to reduce your risk to reward. Yeah. However, that is the task. Let me show you why this task is so important. All right. The reason why this task is so important is if you can do it successfully, you can take a completely different approach, okay, to your prop firm challenge. You can take a completely different approach to it, all right? If your win ratio gets up higher, you can take a different approach to it and you can risk more, all right? With less trades taken, yeah? I'm not saying maybe you can take actual percentage of your whole account size, knowing that you've got about 10 to 20 trades and then you've blown your account. Because if you do this exercise correctly and your win ratio goes up significantly, knowing that you can make a 1 to 3 for argument's sake, yeah, but you're taking less trades, yeah. If imagine that of every 10 trade, you can take a 1 to 4, 1 to 5 trade. All right. Then that means even if your win ratio goes down to you know, you're taking 6 out of 10 trades is going in your direction. If 6 out of 10 trades is going in your direction, or sorry, 4 out of 10 trades is going in your direction, and you can make a 1 to 2, yeah, well then you're going to be making 4%. Sorry, you're going to be making 2% on your account because 6 of them went bad. Okay. 6 of them went bad. This means you got a 40% win ratio. 6 of them went bad. Okay. Me losing your percent each time, just using the percent as a number. So you're 6% down. And 4 of them went well, but you had a 2%. You made 2% on those trades, meaning that you made 8%, you lost 6%. You're 2% up. That's on taking a 1 to 2 trade and have a 40% win ratio. Even if you had a 30% win ratio, meaning that you lost 7 trades and you only won 3, well, you would lose 7% on those 7 trades. But on those 3 trades that you made at least a 1 to 2, which is this, you're not going to take a trade if you're not targeting at least 1 to 2. Yeah. Then on those 3 trades that went right, you in that instance you'd be 1% down. Yeah, sorry, yeah, you'd be 1% down in that instance. Yeah, if you're taking 1 to 2 in those 3 trades, so you have to know where that sweet spot is. Yeah, ultimately, like I said to you, you're aiming for no less than a 1 to 2. But you know, the reality is, if you're increasing your win ratio, you shouldn't be losing 7 out of 10 trades. I'm talking about you should be 4 out of 10 trades you're winning and above, meaning 4 out of 10, 5 out of 10, maybe even 6 out of 10 trades you should win. But your ratio is going to be, your risk to reward is going to be smaller. Okay? Or if for whatever reason we can target 1 to 3s, which is really a 1 to 3 is, there's a sweet spot. 1 to 2 is like you're scraping the panel, and 1 to 1 you shouldn't be trading for 1 to 1s, because at the same time you go in one direction. If you take a loss, you're going all the way back to square one. 1 to 3 is the sweet spot. All right. So say for example this trade here. Let's imagine I take this trade with the stop above here, above that high. Here is kind of the sweet spot. Yeah, a 1 to 3. Because what does that allow me to do? Like I said to you, that allows me to lose 7 trades, to have a 3, out of 10 win ratio. Because out of the 7 that I lose, 7% loss, and the 3 that I win, if I get a 1 to 3, that means 3 times 3 is 9. I'm 2% up. If you're 2% up in your prop firm challenge, you will pass your prop firm in a little over a month, having not necessarily great results. Am I making sense to somebody out here? Am I making sense to someone out here about employing 100%. Jeeves, I'm definitely talking to you. I'm definitely talking to Stars. I'm definitely talking to Darren. I'm definitely talking to Jason. I'm definitely talking to a few people here. I'm saying I want you to test it for a week. And in regards to the amount you're going to risk, if you don't want to if you ain't got the funds to, if you get it wrong, to be able to buy another challenge, you can still stay at a very small percentage of your account, which is essentially not 1%, it's 0.1%. Obviously it is 1% of your, it's 1% of your 10 grand, but it's not 1% of your, say for example, 100K account. But if you feel a little bit more confident, and if you blow your account, you're willing to try again, I'm saying to you, you can increase your risk a bit. All right. So say for example, I'm using the example of a 100K account. You see, on a 100K account, you can only lose 10K. So ultimately, you might as well say that you've got a 10K account. You get it? Yeah. And therefore, when you're taking a trade, if you're only risking 1% of 10K, well, 1% of 10K is £100. Okay. 1% of 10K is £100. But I'm saying to you, if you're quite comfortable and confident, you can maybe push your risk up to 2%, 2.5% if you're wicked. Yeah. Which ultimately means you've got a certain amount of trades before you blow your account. Yeah, you've got a certain amount of trades that you can take that go badly before you blow your account. Yeah, so this is all numbers, guys. Numbers don't lie. And if you stick to the numbers, you should be able to have a good old run. All right. So if you turn around and say that you've got a, and this depends on what account you get. I'm just using 100K as an example. So if you can lose £10,000 in total, that's not in one day, that's in total, because in one day it's £5,000, that's their rules. And you're taking the trades and you're only risking £100 at a time, you've got 100 trades before you blow that account. Okay. But the issue is taking 1 to 3s, making £300 at a time. It's a lot longer journey. All right. So it's fine because you're learning. If you have, 10K that you can lose, and you are taking 2.5% trades, but with a higher win ratio, you've got 40 trades that can go bad before you blow your account. Now, if you're taking one trade at a time with a larger, over a larger zone, placing your stop over a larger area, you shouldn't be able to take 5, 10, 15 trades in one day. You should be able to scan the market, decide, okay, this one looks interesting, i.e., for example, here, gold, all right? You may be thinking it looks interesting. I'd say it's about 7, 8, all right? And you're going to say, cool, this is where my heart is today. This is my girlfriend for today. You're going to check the news, yeah? You're going to make sure that there's no spanners in the works that could come and bite you right on the arse, yeah? In regards to huge moves and swings in the market. You're going to say, okay, yeah, we've got some housing starts, some building permits, but apart from that, doesn't look too bad. You're going to say, cool. And when this market comes and closes below this wick over here, okay, you're going to hit the button placing your stop above the swing high. Yeah, that green line is giving you a great indication in that white dot of where your swing high is. And that is approximately, you might as well just say 100 pips. It's going to reduce your lot size depending on your risk. And you're going to take it and you're going to let it play. And furthermore, you're going to have your alerts at these key levels. Yeah, add an alert when the market crosses down in here. You're going to add an alert when the market crosses down in here. And based upon structure, okay, you're going to take your profits or move your stop loss. In this instance, yes, I'm saying here 1 to 3 would be great, but realistically, when the market gets into taking at least this liquidity here, which is the opposing New York session liquidity, I'm going to be, watching this keenly. All right. But over a longer duration, maybe the rest of the day, maybe by Monday, who knows? I don't know. This market could easily get down to where? To the bottom of our range. Look at our green trend, our green range. Yeah, it could get down to the bottom of that range on a daily time frame. Also, guys, we've seen. Have a look on our daily time frame. We've seen this imbalance because of this big green outside candle here, which I'm going to fill in a different color, which also gives us some sort of like target that the market may just want to come in here and close up that imbalance. So on a smaller time frame, that imbalance is worth at least 1 to 2 to us. 1 to 1.5, 1 to 2 to us. Remember, this exercise is going to be about you letting your trades play out to structure. What does that mean then? That means that before you get into trade, you need to know where you're going to get out. Let me say that again. Before you get into the trade, you're going to need to have some sort of inkling of where you may get out. All right. And where that looks like are these two places here at the moment. As much as I may want it to be X, Y, Z, A, B, C, D, and F, they are here. If that market turns around, that closes where I want it to go, they are here, they are here. And if the sun is shining on a dog, they're all the way coming down into these levels over here, which they look unlikely to happen today. All right, let's see from where we are how much yesterday's market moved. Yeah, yesterday's market moved enough to surpass that number 3. Moved about that distance. Yeah, in one day. How do I know that? Because I went to my daily chart over here. And I simply measured yesterday's candle. Okay, which I don't know why it's not showing me the information up here. Maybe I ain't got a setting on to show me the information about each candle, which is strange. It's not what there is. Either way, look, from this wick here down to the wick here, we can see it's about 3,500 points. All right, and that happened in one day. So why couldn't it happen in this direction in one day? It could do. Yeah, it could do. And if that is the case, we get all the way down here. This is a great trade that you just left to play out. Very low stress, very low, you know, we're worried about this small bit of volatility. We're just going to take our trades in it. And if it loses, we go into our journal and we say 1 loss. Yeah. Whatever that percentage of your account that you've risked, minus. And then afterwards, if there's another opportunity, we take, so I'm going to put some rules in here. And I'm going to let you take a screenshot of it also. I'm going to put the rule. I don't want you to just remember. I'm going to put some rules in for next week's challenge. And we're all going to, I'm going to do it with you also. How about that? All right. We're going to apply some rules in. And those rules, let me do on another chart because this chart is active. Here we go. Those rules are going to be, those rules are going to be, those rules are going to be 1, we are increasing our, well, this is not our point 1, but this is our aim. Our win ratios. That's our goal. Go without a H. Go. Okay? That's our goal. And how we're going to do that is by making sure we are not going to look at candles below 5-minute time frame. We are going to place stop losses. One second. Stop losses above swing highs only. Yeah, above swing highs only. Swing highs only. Okay, we are going to only, okay, we are going to only, oops, let's get into here. This is going to be great for a lot of people. We are going to only take 1 trade at a time. Okay. We are going to either win or lose. Here we go. For this test next week, no break evens. Okay? Guys, this is going to be a great test for you guys. And for a lot of people, they're going to love this way of trading and they're going to employ this. Okay? We're going to either not wing, all right? Man, straight out of a Shaolin movie, you know, we're going to wing, yeah? We are going to either win or lose. No break evens. Okay. You like that, Darren? Yeah.
Yeah, I was gonna say, but
We um are are going to calculate our max risk based upon our ability to no, I'm not going to give you that much flexibility. I'm going to tell you what it is. We are going to calculate our max risk between 1 to 2.5% of what we can lose. All right. That means depending if you've got a prop firm account, if you've got 100K account, 400K account, 10K account, if you can only lose, if you've got 100K account, you can only lose 10K. But then you got to calculate your risk based upon what you can lose. When you get better with your win ratios and you know how much you win, how much you lose, you can be a lot bigger in your risk in prop firm accounts when you know the data. What do I mean by this? I mean, if I know that I've taken 100 trades and out of 100 trades, I win 70, yeah, and I lose 30, even if my risk to reward is only, 1 to 3, which is not huge. It is you risking $100 and making $300. That is not huge. But if I see that, then I am in a profitable position because I can lose 7 trades, losing 1%, okay, of what I'm allowed to lose. Yeah. So that means if I got 10K, 1% of that 10K is only $100 at a time. Yeah. And even if I have, like I said, I lose 7 and only win 3, at 1 to 3, I can still be profitable because from those 3, I make 9%, opposed to my 7% I've lost, I'm 2% up. Okay, let me put some more caveats in because I'm doing it off the top of my head. This is going to change a lot of things for people. Okay, we must see at least a 1, 2, 3 from our trade idea. Now, within saying that, when I say we must see 1 to 3 from, I mean, don't take a trade where you can only see it go into structure for 1 to half. That's done. But what I would say is this: we must see at least 1 to 3 from our trade idea. However, if markets are slow, if news is coming up, if end of day approaches, approaches, does that look right? I think so. Who knows? All right. If markets are slow, if news is coming up, if end of day approaches, what else? Whatever, etc. You can take you can settle with 1 to 2 trade. I don't want you taking 1 to 2 trades. I don't mind you taking 1 to 2 trades are acceptable. Okay, but you should be aiming for 1 to 3. All right. What else? Don't fiddle with your trades. Let the market play out. we are increasing our win ratio. I'm going to put in here potentially this will reduce our R2R, which is risk to reward. Okay, we are not going to look at candles below 5-minute time frame. We are going to place stop losses above significant swing highs, lows. Yeah, because we're not only taking sells. Only. We are going to only take one trade at a time. I do not want to hear that you're in GU, gold, and EJ. Okay, we are going to either win or lose. No break evens. Yeah, okay. We are going to calculate our max risk between 1 to 2.5% of what we can lose. I want to just say 1%. I'm saying 2.5% is for the people, and I don't know if I think I don't think I should give parameters like this. I'm going to drop this. I'm just going to keep it like that. Okay, of what we can lose. Okay, we must see, if you're more advanced, you can see the deviations that we can make staying within this same structure. More advanced traders can do the same thing, but maybe they're risking a bit more. Maybe they're taking up to 2 or max 3 trades at a time, but let's just say 2. Yeah, as you're a bit more advanced. So that's where you can see the parameters can be manipulated, can be changed. Yeah. Don't forget. Also, this is going to allow you. This will allow you to journal, document each trade. Because the reason why people don't like journaling, and I'm telling you, I'm giving you the reason why, it's because they take 40 trades a day, 20 trades a day, 12 trades a day. Who wants to journal 12 separate trades a day when you got a job to do, you got life to live, the kids are screaming? But when you're taking one trade at a time, which may mean you took 2 trades in a day, maybe your trade plays out wicked and everything's going good. May mean you take 2, but you're not going to be taking 10 trades in a day when you're placing your stops above swing highs and you're letting them play out. It's unlikely you're taking 10 trades in a day. So you can journal them. Yeah? You can journal them. And what do I mean by journal them? Simply, you can journal in any way. You can do it with a pen and paper. You can do it in an Excel spreadsheet saying, I took GU for the sell because of these reasons at this time, and it won or it lost, and this is how I felt when I was taking it. This is how much I risked. This was my account size. Like, you can just put whatever you want in it. Yeah, I can provide you a journal Excel spreadsheet, which I think I've done before in the past. Maybe, all right, for you got to be able to do that. But this is going to transform a lot of people's trading, because a lot of people right now understand the market structure, understand price action, but they're not getting the results because they are not the best at their entries or placing their stops in the right place, or not fiddling with their trades. They fiddle. They're fiddlers. Okay? They're getting a trade, and before you know it, they're moving their stop to break even. Okay, we got stopped out for break even. I made no money. And because now they're so eager, because they see it going in the right direction afterwards, then they start hitting the button again in the wrong place, a little bit more risk that they've risked. They should have used 1%. Now they're at 1.8% because they was chasing it. Boom, boom, boom. And yeah. And then the market kicks back on you, boom, stops you out. And then you're like, oh my gosh, it stops you out, but you're vexed now. Now you're on tilt. When you're on tilt, it's like you're in the zone. It's like you're vexed. You know, when you're vexed, a man tell you to allow it, stop, but man still want to fight. There's a split second when man just got that energy, just want to do madness. They're not thinking straight. They're just so outraged by the fact that you had the audacity to slap, they had the audacity to slap you in your face. You're not thinking straight. You're doing madness for about 2 minutes. And then you realize, whoa, I'm in the middle of Lakeside and I'm probably going to get nicked. Let me stop doing that. This happens in trading. You start taking the L and you're like, oh no, it's going down anyway, man. Look at it. Just stop me out for 1 pip, half a pip. Let me get back in. Hit the button again. You hit the button. The same time you hit the button, the market goes, uh-oh, other direction. Yeah, other direction. Yeah? And then you're like, oh my gosh, I took another L. You're just taking L's. You're like you're playing Atari. You're just hitting the button. Yeah? You're just hitting the button. This is going to change that. Because what you're going to do, say for example, in this gold trade here, can you see this one here that we're talking about? You are not going to get in this trade until, for example, you saw the market close down below here. And if you did take this trade, your stop must be above the swing high. How do you identify the swing high? Draw some bloody lines. Yeah? No smaller than the 5-minute time frame. Draw some lines. Look, the bigger swing high is over here. Above this level over here. Yeah, but we're not going to do that and have you lot in the trade for the next week and a half, taking one trade at a time. Yeah, but you place your stop above here. The market hasn't given you an entry yet. And I'm not trying to say you're just going to take the trade based upon it closing below here. You're still taking the trade based upon all the things that we look for. Yeah, indication, correction, continuation, it's happening, whatever it may be. Looking for the divergence that we did lots of work on divergence. You know, we're going to be doing more every single day. We're adding that in as confluence. So for example, we're looking at complementary pairs. A complementary pair to XAU is XAG USD. We make sure that in this little tool over here, can you see this tool over here, which is allowing me to split my screen? It's this one here. I can split it into 1, 2, 3, 4. I can split it into 16 if I want to. Yeah. But in this tool, we make sure at the bottom where it says sync layout, we are synced our crosshairs, syncing these different things. You can toggle them on and off and see what they do. But this allows me to, can you see? When I'm moving on one screen, it's also in the same time. Yeah. And when I drag my screen, I drag both of them. It gives me control over 2 different markets, gold and silver, with one action. So therefore, when I'm looking for divergence, yeah. Therefore, when I'm looking for divergence, so say for example, in this instance, I might be looking for divergence between some data points, all right? Then I can easily see, mark out the divergence between the different points. Yeah. So this market, we might see for argument's sake, this one come all the way up here. I'm not saying it has, but it might come up here, push back up in here, but this one not push back up in here. That would mean that one is going in this direction and one is going in this direction. And that may give us an additional confluence that maybe a reversal is going to occur to allow us to get into the trade. Okay, I'm not saying that's what's happening. I'm just saying to you that's an additional confluence that we touched upon this week that you can also add to liquidity being taken. You can also add to, seeing our breaking structure. We can also add to market structure and price action. We can also add to, is the market in a premium or a discount? We could also add to what's happening fundamentally with news. We can also add to the market's already gone and closed an imbalance. Yeah. And within that imbalance, we're seeing structure being broken in the opposite direction. Okay. But what we are doing with this rules is for a week, which is going to be next week, which I'm going to join you with. You are going to be taking trades and you're going to be looking to do one thing, which is increase your win ratio. Yeah. I do not want to hear that you are taking, I heard some stats, somebody took 87 trades and won 17. Okay. 87 trades. Now I'm telling you something for free. Okay. And I want you to understand it like this. If mommy sends you to the shop to go and buy, I don't know, go and buy me some 2 watermelons. Yeah. And she wants the best watermelons. You know what I'm talking about? The ones that are a certain shape, the ones that have a big yellow patch on them, meaning they were sitting on the ground for a long time. They're meant to be the sweetest. The ones that are good size. And you go to wherever you go to buy your watermelons, and there's 100 watermelons or 1,000 of them. Let me tell you something. No, not 1,000. Let's just say 100 of them. Let me tell you something. 87 of them are not the best watermelon. Yeah? You have to be discerning. Take some time. Roll over as many watermelons as you can physically get to and go, yeah, this one, even separate them, like, yeah, these 8 are looking fantastic. Do you get what I'm saying? And then even go back into those 8 and go, that's the best 1 or 2 watermelons out of the 8. Good size, boom. There's no, there's no damage to it. You can't see that the skin's been pierced already by whatever. Yeah, all the conspiracy man just trying to cut into your watermelons before you get them home. And you think to yourself, you know what? Out of the 100 watermelons that I saw and that I was able to reach, because you're not able to reach all the way to the bottom of the barrel, fair enough. Yeah, these are the 2 I came home with. This is the kind of discernment that we need when we're taking our traits. Man just can't be out here going, yeah, you can go in the basket. Whichever one's closest to me, that can go in the basket. Because that isn't you looking for the best watermelon. That's like you're in a rush. Like you got somewhere to go. Like, damn, I gotta go get this watermelon. Let me quickly just go and run in there. Yeah, I'll take those 2. Let's go. Only when you got home, you're like, this watermelon's got a cut in it. This watermelon is not sweet at all. It's small. It's looking all brown and mad. It's looking, you're like, why did I even grab this? I didn't grab it. I grabbed this one, sorry, because I didn't pay attention. I didn't pick the best. So you see, a trade like this, whereby you're looking at it, now I'm not trying to say gold is the one, because I've only looked at gold today. We haven't looked through our pairs, which I'll do now, all right? But I'm saying, you want to take a trade that at least looks as though it's giving you these things that you're looking for. It's giving you all those things that you're looking for in a watermelon. Do you get it? This is why this energy here is going to slow you down, Tyson. Yeah? It's like, man, like some people, when they had all their weapons, the first thing they went and picked up is the machine gun. Like, you've got no aim anyway. You can't aim a handgun. But you went and picked up a machine gun so that you don't only accidentally, hit one person that weren't your target, you hit the whole disabled school kids that were crossing the road and the zebra crossing. You mow them down by accident as well with your machine gun. Because your aim is terrible. Because you're taking 100 trades a day. So what I'm now doing is saying, I tell you what, bro, put the machine gun down, put it on the side. I know you're eager. I know you're keen. I'm going to give you this one sniper rifle. It only has 1 bullet in it at a time. After you take one shot, even if you wanted to take another shot straight away, you've got to go and get another bullet, got to put it in a chamber, open the chamber, put it in there, lock it back down, click it back down, get back into position, sit down, look through the scope. That gives you at least some time to get a little bit of USA, yeah? A little bit of Zen. Before you start squeezing again. It's unlikely you're going to lick down all 30 of the school kids walking across the zebra crossing when you've only got 1 bullet at a time. Unless you're going to John Wick them and lick 3 people down with 1 bullet, yeah? This is what I'm trying to do, because at the moment it's far too easy for people, and this is what the prop firms rely on. It's far too easy for you to just do this. You know that sound? We love that sound. I lie, you love that sound. It's too easy for you to get in a trade. Yeah? So this is going to slow you down. And it's going to document. Let me tell you why this is so priceless. Because if you do understand the strategy, market structure, price action, understand certain things, yeah? At the end of this journey, yeah, you're going to have some data. And the data is going to say that me, Alan, I have a 5 out of 10 win ratio. Meaning that if I take even just 1 to 2 trades, yeah, if when my cutting gets to 1 to 2, I move my stop loss. If I can do that every single time, even with my losses, I'll lose 5%, but I will win 10%. Because 5 times 2, risking 1% at a time, making 2% is 10. 10 minus the 5 you've lost is 5%. actually means that in 2 weeks, if he was taking one trade a day or whatever it may be, he passes a challenge. The data is essential. Yeah, the data is essential. And then what we can do when we get more advanced is maybe we don't have to place our trade above the swing high. Maybe we place it above the minor high. Maybe we test that for a week. Does that give us better results, or does that drop our win ratio? Does all of a sudden Alan start winning 3 out of 10? And he goes, whoa, wait a minute, that's going to change some stuff. I'm either going to have to target 1 to 3s now with my 3 out of 10 win ratio, or I'm going to put my stops back above swing highs and get back to my 5 out of 10 win ratio. Am I making sense to somebody? I hope I'm making sense to somebody. Somebody, am I making sense? Please give me an amen.
Perfect sense.
Yeah, because it's too easy to take lots and lots and lots of trade. I am not talking at you. I'm talking to you from my own experiences. Learn from other people's experiences. This is the reason why we should read books. If you read a book about an entrepreneur and how he did it, you are learning from his experience. If he says to you, you know, setting up a shop there, boom, do, you must have X amount of costs and this money set aside because he's done it for the last 10 years and he knows, do not go and do it. Like, take heed the information, especially if you value that person, you look up to that person as a businessman. Say, okay, I remember Richard Branson saying that if you're going to go and do this, at least have 30% worth of money put aside because sometimes delivery times will take longer. You don't know nothing about delivery times. You're just getting into the business. You might as well heed somebody who's been dealing with delivery times for the last however long. Learn from other people's mistakes. Learn from your own mistakes, but learn from other people's mistakes and other people's experiences. And I'm saying to you, this is a great test for you. If you don't want to go and pay for a trade, a funded account, go and get a demo one and test this. Test what it feels like to be patient, and instead of taking 12 trades in a day, you took 1. Test how it feels to, instead of maybe making £1,000 in that day, you only made $400 that day, $500 that day. Because you see the guy who makes 1,000 in that day, he only make that 1,000 on Wednesday. Monday and Tuesday he was losing money. And then Thursday and Friday, he was also losing more money. So in the end of the week, he's actually down 400. He did make 1,000 on one trade. But when he adds that 1,000 up in one trade, with all the losses he's been taking, he's down $600, $700. So it's a completely different energy. Patience. Boring. Let's make this thing boring. Not how many trades are we taking? What are you in? Yeah, I'm in this trade, that trade, this trade, that trade, and this trade, and I'm looking at this other trade as well. Man, like, is it really? Rah. Yeah? So we're gonna watch it. We're gonna look, we're gonna see, we're gonna make decisions. Yeah? Say for example, if I'm looking here, I'm showing you. This is my 5-minute time frame here on silver, which I won't be taking silver. I don't like silver because it has a large spread. Yeah? If I had my choice, it'd be gold than silver. That's quite a large spread. But on the 5-minute time frame, and I connect some dots on silver, I've got to make a decision about where my swing high is. And look, the easiest way I do that is by identifying some dots, a high, a low, a high-ish, a low. If I take a trade in silver, I need to place my stop above the swing high. It's a little bit different, it's a little bit closer in gold, but that's the real of it. And like I said, and that means that I'm going to make a decision that if I'm selling this, for argument's sake, let's say I'm selling it, I don't have no problem with waiting till this market comes, maybe New York, I have to wait all the way to New York. And then New York goes and takes London highs. And then I see my breaking structure. Then I see my imbalance. Then it corrects and then it continues. Then I see my divergence between my two pairs. And then I take my trade and I place my stop above the swing high on the basis that I'm targeting opposing liquidity. Yeah, wherever that may be. And that's what we're going to do. And we're going to practice until, and then after the end of the week, we're going to be able to sit down on Friday or maybe on the Monday, yeah, and say, tell me your results. And if man tells say, well, basically I took 20 trades and I lost 19 within this, there's a bigger problem. Yeah, because you're giving your trade space to move. You're giving your trade space for the volatility. You're giving your trade space that, oh, this news came out. Because sometimes when you see, I'll say this, look, check back in the group and I've gone, woo! And this volatility, the market erupts. Only really erupted on a smaller time frame. It only really, like that move, yeah, there was a big 20 pip candle in GU or big, whatever, maybe 12 pip candle, big spike. Didn't really push to nowhere near the swing high. It was just an abnormally big candle amongst small candles. So like I said, this will reduce your risk to reward, but it will and should increase your win ratio. And when you increase your win ratio, you're going to build confidence and you're going to feel as though, you know what? You're going to confidently be able to say to your brethren, give me your money, bro. I can double your money. If I take trades and I know that 7 times out of 10, I'm going to get a 1 to 2, a 1 to 3, that means I can take your £100, I take your £1,000 and I can give you back your £1,000 plus £1,000 on top because I made a 1 to 2. So I can take £1,000 out of that. Can you see how money managers make money? Now, I'm not trying to say you are qualified or have, because by law, you have to, you can't be advertised as a money manager. I'm taking people's money. All right, unless you're qualified. But you could take, if I was doing that regularly and I'm confident, I could say, listen, to one of my friends or my family members, look, give me 10K. And based upon my data, within a week, I'll give you back your 10K plus 10K on top. How am I able to say that? I'm able to say that because I've got let me not say 10K, it's too big. Let me say £1,000. I'm able to say that because I've got a 100K account. Yeah, or I'm going to give it to them over a month duration because I know my returns. Let's imagine that I make a certain amount of money in returns. Yeah. But I'm saying, you get my point anyway. Obviously, I'm just trying to work it out so that you're not going to take 10K and put 10K in the markets, yeah, and double the money. I'm not saying that. So I'm just saying, like, you're able to confidently know that you can double someone's money. Not exciting. It's not going to be you taking some high risk trades. You're placing your stop above the swing high. And it's calm. But if you can do that consistently, you are a trader. You don't even have to start trying to tweak it to increase your win ratio. You might just be like, listen, I take 1 to 3 trades. I've got a 6 out of 10, win ratio. Or I lose 4. I mean, I only win 4 out of 10 trades. But let me tell you something. See, out of them 4 trades, out of the 10, I get 1 to 3s. So I make 12% out of the 4 that I win, and I lose 8% or 6% out of the ones that I lose. Yeah. So I make 6% a week. 6% a week over a month is what? 24% in a month. I mean, 24% in a month ain't a joke. That's me giving you 100K, and by the end of the week, you got 125K. Or by the end of the month, you got 125K. I mean, that's not a bad return. Now, even if you fall short of that, you are still somebody who can grow your own wealth or grow other people's wealth. Am I making sense? And the joke is, these trades that you're taking, none of them were 1 to 10. None of them were 1 to 5. Not one of them. Yeah? They were just low risk, high probability trades that you allowed to play out, and you didn't, start trying to juggle a million things at once. You let one trade play out at a time, and when it lost, you wrote it down, lost. Then you started again looking for a good trade that had all of these ticks in the box on our checklists, and then you did it again. Yeah? Any questions, guys? It's Friday. Any questions about anything? We've got about 5 minutes. Anybody want to say anything about news, about anything, about the world, about boom, about what I've said to you? And I'm telling you, I'm going to be doing it for you next week, and I'm going to journal it, and I'm going to make it public to you guys.
Grand Rising all.
Grand Rising now.
Yeah. Nick, sorry, I'm not being well. Just
Did it get you?
Yeah, man. I just went to the office on one day, and boy, there's people out there they don't know to stay at home, when they got
Oh,
to.
it got me as well, Al. So I feel your pain because you see the thing that I had before Christmas, and I'm somebody who I don't really get. Oh yeah, the thing I had before Christmas. There was one night I wanted to cry like a baby. I was like,
I hear you, bro. I hear you. Listen, lots happening this week, as you know. Sorry, I put stuff in the group. If I don't come online, I'll put stuff in the group and let you know what's going on. Lots going on UK, lots going on worldwide. There's no US holiday on Monday. It is Martin Luther King birthday, and also the inauguration. I think if you've been on a call over the last 6 months, you'd realize that, there's going to be volatility from the 20th onwards, because Trump is inflationary. His policies are going to be crazy. So just watch this space. It's a lot of movement in the market from the 20th. Tuesday is going to be a very busy day for trading onwards. He obviously looks at the stock market. He wants the market to be high. It's like a measuring stick for him. But listen, there's going to be a lot of whipsaw. So you know what? Just watch that space. It's going to be a roller coaster. I've taken everything in what's been said on Bloomberg, what's been said on the other channels, and what's going on in the world. So lots happening. I think there's a few red folder news today at 1:30, but the market kind of next week's going to be the one, and then the week after you've got a lot of interest rates. You got the BOJ, you got the Fed. I think the ECJ, and then the 5th of February, you got the UK. Reason I put the UK is there's a lot going on in the UK market at the moment, and a lot of pressure on the Chancellor via a lot of things. She's got a bit of leg room, just a little bit of, rest from the what's going on. The market's putting a lot of pressure on her. Pound is, low. And listen, I think the pound's going to get lowered. I think if anyone saw me put a screenshot of what the bet's on the pound at the moment, another 8% they think it's going to drop. So if anyone's traveling at the moment or traveling in the near future, boy, you better get your currency now. Any questions, anybody?
I think. Go on.
Any questions? There's a lot going on. There's a lot. Listen, you got to look for trading. You've got to look at worldwide. What's happening? I think I've said this before. If you trade in a currency, look what's going on in that country or both countries. The pairs really important because it does. Prime example when Trudeau, before he resigned, he was under a lot of pressure. The CAD, the Canadian dollar, was getting battered because they wanted him removed. So these things happen with the French as well when there was going on their upheaval in their parliament. The CAC, which is their indices, was getting a battering. Listen, sentiment's really important, as well as technicals, as well as fundamentals. Understand that, put that in your trading, and trust me, you go far.
Said by the one and only Alan, my resident fundamental specialist, proud to say, many years under his belt now, studying the fundamentals, and a real force. Guys,
we give love and gratitude to Brother Alan.
Love and gratitude, definitely for him.